And the old phone, you can just dial in, dial out. Well, you guys are too young. You don't even know what a rotary phone is. But the, iPhone, it can do everything. And that's today. There are so many different options. So I would say that the main misconception is just the mentality that paying off a mortgage is the thing to do, and getting around that is probably our hardest roadblock.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride. Welcome to Critical Thinking Required. You're with your hosts, myself, Tim Bickmore, and my two colleagues, Dan Weiss and Nathaniel Leach. And today we have a guest, Cece Delgado. Cece, thank you so much for joining us today. Cece works for Fairway Mortgage, and she is a reverse mortgage expert. And we are going to be speaking to her today about reverse mortgages. Reverse mortgages have a lot of different connotations to them when people hear them, but we're here to have the conversation, to open it up and discuss what that tool can look like when it comes to someone's financial plan. Before we jump into that, I have two things. First is our little shout out to ourselves. If you do enjoy our episode, please like, share, and subscribe to our podcast channels. And then I'm just going to read out Cece's bio to our listeners and viewers so we can get a good understanding of who we're speaking with today. Here we go. Cece Delgado has spent most of her life in San Diego, California, and spent 15 years in Denver, Colorado, where her mortgage career began. She is a nationally recognized expert in reverse mortgages with over 25 years of experience in lending. She has traveled throughout the country teaching loan officers, realtors, banks, credit unions, and financial planners about the advantages of reverse mortgage. She has been featured on K-Prize and ESPN radio stations and is a trusted expert with the MBA magazine and National Mortgage News. Her passion is helping consumers and professionals alike understand why the HECM reverse mortgage is a potent financial tool when properly understood and applied. I like that emphasis there. She is the account executive for the Western region of Fairway Independent Mortgage, handling California, Arizona, Nevada, Oregon, and the state of Washington. Cece, thank you so much for joining us. We really do appreciate it.
Well, thank you guys so much for having me. I like, share, and have subscribed to your podcast. I love what you're doing. You are taking kind of a different twist on financial planning, and I love it. It's needed. This new, fresh, young blood is awesome, and I'm honored to be here.
Thank you so much. We appreciate those comments. And just like Cece, please do subscribe and like our podcast. We do appreciate it. So thank you, Cece. Dan, I know you want to start us off, kick it off with some questions today. So I'm going to let you take the helm.
First, we're honored to have you, Cece. Thank you for joining us. You've been a wonderful resource to clients of ours, and I know that this is going to be educational and insightful for everybody. This is a topic that there's a lot of confusion on, and I've got a couple questions on that from a clarification standpoint. I think I recall really hearing a lot about reverse mortgages right around probably just before perhaps we saw the financial crisis show up. And I know there's been a lot of changes since then. Can you talk from a history standpoint a little bit about where this segment of the industry has begun and what that evolution has looked like to get to where it is today?
Sure. So that's the age-old question, right? What the heck is a HECM? So the home equity conversion mortgage, better known as a reverse mortgage, actually became FHA insured or government insured in the 80s during the Reagan presidency. And since then, there have been many milestones that have made it the safe financial tool it is today. So, for example, nowadays we have to have counseling by a third non-interested HUD-tested party to make sure that the consumer understands from a third party how it works and understand what they're getting into. We now allow up to 4 units instead of one single unit, so long as the borrower occupies one. We now can refinance a HECM to another HECM. loan limits have raised with the market. So now we have a loan limit of 822,750. So it's right there with the market. It helps in San Diego, even though the median price in San Diego, I believe, is 860 right now. There are limits now on origination fees. And they've also kind of made it a lot more, it's not as easy. It used to be pretty much if you had enough equity, you can get a reverse mortgage. So now they've put some guidelines in place. So they don't allow the one lump sum disbursement in most cases. It'll be a first and second year disbursement. Also, we do a financial assessment now to make sure that the borrower has the means and desire to keep up taxes and insurance. If during that financial assessment we find there's an issue, then we'll do something called a life expectancy set aside or a LISA. And then we will go ahead and withhold taxes and insurance to ensure that they're going to be on time and their taxes and insurance are taken care of. And then probably one of the biggest ones, because I think it was probably the biggest issue that kind of gave the reverse a negative connotation. So what happens is a lot of times, I'm just going to use the gentleman as a example, will marry a younger woman. And so now they're 62, but their spouse is 50. And so what used to happen is that the younger spouse, when something happened to the husband, they would have to sell the house and move. Well, they may be older now. And so they may want to age in place and stay in the home. So now we have an NBS or non-borrowing spouse, which is required now. So if you're married to a younger person, then that person is now allowed to stay in the home for the remainder of her life or his life. So this has become a huge comfort for spouses. So those are probably the main changes and milestones that have been made with the reverse to date.
Which is a lot. And
a lot.
So you just gave a great example, right, of a demographic that really can benefit from a product like this, a situation like this. Can you talk a little bit more as to where maybe someone isn't thinking that there's a benefit there, and where we've seen it, right, in different situations, where other populaces may benefit from a product like this?
You mean aside from like a 62 or over? So basically the general guideline is 62 or over, 50% equity, still making a mortgage payment. I think the populace that probably misunderstands it the most are people with wealth, people that, have a few $1 million or $1 million that they don't feel like they need it, or the house is paid off, so they don't feel like they need it. And, we're kind of getting to a point now, we have a lot of loan officers that, their average portfolios are anywhere from 600,000 to 3 million, because they now understand that there's a tax advantage to a reverse mortgage, using a reverse mortgage to offset, mandatory distributions, or using it for cash flow instead of taking from their portfolios in a bear market. If they leave it in there and a lot of times when you're older and you're in retirement, you take that money out, you don't have the means to put it back in because you're retired now. You don't have that income flow coming in. So with a reverse mortgage, you can take from that line of credit to live on instead of taking from the portfolio. And now I'm sure you guys, this is definitely more your wheelhouse, but with regard to sequence of returns, you're going to get a lot more length of income from your portfolio by using the line of credit from a reverse mortgage to live on in bear markets. So I think that's probably the biggest populace is going to be the more wealthy or affluent client. It used to be the loan of last resort. It just isn't that anymore. There's just so many different strategies that can be used with it. And so I would say that would be probably the biggest group.
I think that's a great answer, and that's something people would expect. As you were mentioning some of these changes, you can't, there are restrictions as to how much you can have an origination fee for, right? There are some misconceptions.
Definitely.
Where, as this product has evolved, there have been times where, just like anything else, people have come in and abused abuse situations, and that, of course, that's what people remember. I'm guessing the most common misconception that you hear is that, oh, I've signed over the house and now it's gone, and the institution owns this, and that's the end of the day. That's not the case, and I'm guessing that's the largest one, but I'm making this assumption. I'd love it if you could take a little time and discuss about that. Now, I know that Nathaniel or Tim might have some more questions to get in greater details about what that process can look like when someone leaves and so on. But if you could talk a little bit about that misconception and other misconceptions perhaps that you might hear. And obviously, like anything else, it's not a fit for everybody. So it might even be helpful to get a grasp of where maybe the product isn't bad, but still the usage didn't make sense, right? That would also be helpful.
Sure, thank you. Those are great questions. So for who the product wouldn't be for, it wouldn't be for somebody that really wants that house to be the legacy, where they know that there's one offspring that's going to want to live in that house and stay in that house. That may not be a right fit for a reverse. The other one would be if they're planning on only staying in the home for, a few years, 3 years, 2 years, and they know at that point they're going to go live by their grandchildren or something. That would not necessarily be a good fit for a reverse because of the costs involved with the reverse mortgage. So those would be the two scenarios I would say. Other than that, there aren't really very many other situations that would not make this work for them. With regard to misconceptions, you nailed it. It's the bank's going to take the home. So that would be the first misconception. So way back when these loans first started, the bank was on title with the borrower. So when they entered into a reverse mortgage, the bank would be on title with them. So if anything happened, the bank could come and now they own the home. That is not the case anymore and hasn't been since the 80s. A reverse mortgage, and I guess the best way to think about it, Dan, is that it's just like a traditional loan. If you don't pay your taxes and insurance, then they're going to foreclose on the property, just like they would on a traditional loan. So that is, I guess, the best way to think about it. The one other thing, though, is you do have to occupy the property with a reverse. So you have to live there. So that would be the first misconception. The second misconception is the heirs are going to, or their kids are going to be left with all of this debt, and that, they're going to leave them in a bind. So that the FHA HECM is a non-recourse loan. So basically, if, for example, we don't know what's going to happen with the market right now. And so if, let's say, you have a house and you've entered into reverse and it's worth, $1 million, and then 10 years from now, 15 years from now, something happens to you, and now the house is worth $400,000 and you owe the bank $600,000. It is a non-recourse loan. So the only thing that is owed is what the house is worth. And at that point, the heirs could actually purchase the home for 95% of that value if they wanted to keep it. Otherwise, it's put the keys in an envelope, mail it to HUD, and that's it. It's a walk-away loan. So that's the second misconception. The third one, or the third, pushback, if you will, that we have with it is the cost of the loan. Because people that have 50% equity, they're like, why do I have to pay mortgage insurance? On a traditional loan, you don't have to pay mortgage insurance. So the reason is there's a 2% funding fee, or it's actually an upfront mortgage insurance premium, but it's just like the VA funding fee. It's 2% as well. So it's just like a government loan. But in this case, again, it is because it is insuring the loan for the lender as well as the borrower, and it's non-recourse should anything happen or should that loan not get paid back. So those are probably the four main ones. But I'm going to tell you what I think the biggest misconception is for seniors today. I'm going to tell you, our 70 and 80-year-olds are the greatest generation of our time. But they are also from the Depression area. And back then, the holy grail of retirement was paying off your mortgage. Like that was it. That was the deal. Look, I paid off my mortgage. And then they're sitting on a ton of home equity. But in fact, it's kind of a lazy asset, right? I mean, it doesn't do anything for you. It's paid off, it's sitting there, and it's not doing anything for you. We contribute most people contribute 30-40% of their income into housing, mortgage payment, improvements, and and also to pensions and IRA and 401k and 403bs and everything. And they take it back. They start taking, money back when they retire, but not with the house, right? It's still there. You can't take off a screen door and go buy dinner, it's just there. So with a reverse mortgage, it allows you to have that flexibility. And it's just a matter of getting seniors' minds around the fact that it isn't like it used to be. Our division director, Harlan, he says, what if everything you thought you knew about mortgages was wrong? When would you want me to tell you? And so that's the way it is now. It's the old mortgage and the new mortgage. It's just different. There's so many different options now. Another analogy is the rotary phone and the iPhone. The old mortgage, it had one purpose, and the old phone, you can just dial in, dial out. Well, you guys are too young. You don't even know what a rotary phone is. But the iPhone, it can do everything. And that's today. There are so many different options. So I would say that the main misconception is just the mentality that paying off a mortgage is the thing to do, and getting around that is probably our hardest roadblock with seniors, is to really make them understand.
Cece, during the Great Financial Crisis, was there a lot of changes to reverse mortgages, and were there certain, I guess, areas that were hit the most within the reverse mortgage sector that really caused issues with this type of mortgage due to equity of homes falling so much, which, like you said, right, up to 50% of equity, you still own, half of your home. Equity prices, home prices would have to drop significantly for you to be, quote unquote, underwater on that reverse mortgage. But I'm just curious, just from your experience, if there was changes that came out of 2008, just like banks in general changed significantly with the amount of assets that were held, but just curious specifically with reverse mortgages.
I actually love that question. It was something I was going to get into later on. And I love that question because, we have financial assessment now. So that was probably a change that occurred. But more importantly is that with the reverse mortgage, that line of credit continued to grow. Same with when COVID hit. The HELOCs, Wells Fargo, Bank of America, everything was cut. No more HELOCs. Lines of credits were cut off. If you were in the middle of improving your home and you had $100,000 line of credit, it was no longer available. But with the reverse mortgage and the line of credit, that remained, and the growth remained. And so that is an absolute advantage. When COVID hit, the market dropped 35%, right? And it's back. It bounced back. But, we have everybody that had a HELOC, they were cut off. No more. Wells Fargo, just in the last few weeks, there's no more HELOCs. They're not doing, because they don't trust this appreciation, right? And so they have cut off all HELOCs. Bank of America followed suit, where they now have limited their HELOCs. That is not the case with the reverse. So we still have that line of credit. We still have that growth, and it is based on the current value.
Cece, can you walk us through what a typical underwriting process looks like?
The good news with HECMs is that they are FHA insured. The bad news with HECMs is that they are FHA insured. So every single one is manually underwritten. There is no automated underwriting system like there is with traditional loans. And, there's a lot of paperwork involved. A lot of seniors, it's changing. It's changing, but a lot of seniors do not scan and do not send documents in. So it's very timely. But it's also good that it's timely because, it gives them a chance to kind of go through this process, understand it. We get to understand them more. In California, there's a 7-day cooling off period. So after you do counseling, we can't incur any cost to you until 7 days have passed. So you can think about it. And so we cannot order it. We cannot order appraisal. We cannot order title. So there's a lot of protections for the seniors with a reverse, but that also entails, some time. So yeah, they're manually underwritten. We do need a lot of paperwork. We typically will be back at their house or send somebody back at their house, a few times to make sure if they don't have access to technology. But that is probably the main thing, is the timeliness of it.
And can you describe to us, are there different types of reverse mortgage products available?
Sure. So there's not only different types, but there's different options. Okay. So we have just the traditional, HECM, and has two options. They have two adjustable rate options and then a fixed rate option. And so in that situation, they can, choose a higher rate cap on the adjustable or a lower. People that have a large line of credit, they may want that larger cap, that higher cap, because their line of credit is growing at a higher rate. And so it just depends on their situation. With a adjustable rate, you can also choose to do a 10-year payment. So what a 10-year payment is that you can, for the life of the year loan, get a certain amount of money for the rest of your life. $1,000 a month, $2,000, whatever that calculates out to be. You can get a set 10-year payment for the rest of your life. You can also get a term 10-year payment, which means, let's say, you only need money for 10 years. You're going to have an inheritance in 10 years. So, you can have a larger amount for 10 years or something like that. So you can figure out whatever way you want to work it. And then you can just get a fixed rate where you get it all at once. And then there's no flexibility there. Once you're fixed rate, then that's what it is. Believe it or not, the most commonly used is the line of credit. The other advantage to that is if, a few years down the line, you have a line of credit or you have a 10-year and you go, I need, something's happened with my health. I need to get a large amount of money right now. You can switch it up. I think it's a $25 fee to the servicer, and you can change it up, but not a fixed rate. That's set in stone. And the only way you can get out of that is to refinance. We also have now, and they're becoming more and more popular, proprietary products. And so that's going to be typically is for a jumbo loan. So people that have a $2 or $3 million home, they're going to fall into that proprietary product. It is different though. It is not the same as a traditional loan. So a jumbo product, that line of credit only grows for 7 years. Whereas with the traditional HECM, it grows for the rest of their life, or as long as they have the loan. The other difference is that if you don't use that line of credit with the jumbo loan, within 10 years, it goes away. So it is different. It is different. But those are the products. Yeah, we've got jumbo and we've got the traditional HECM.
And Cece, at our company, we always like to talk about incentives, because we feel incentives always drive people to where people are making certain decisions. And so I'm curious, if we flip this on its head, and I appreciate the products and stuff, and I'm just curious for our viewers or listeners, and say, what is the incentive of the bank to do a reverse mortgage?
So that question may be a little bit out of my wheelhouse because I'm not a secondary marketing person, I think. But as far as an advantage to the bank, well, it's compounding interest, so if a borrower is not making payments and that their loan balance is going up, then they are making interest on whatever that new balance is. It's negative amortization.
And that's kind of where I was getting at. But the benefit back to the client, right, theoretically, is that as they pass, given that their kids don't want the home, or somebody else doesn't want the home, that when they sell the home, the bank gets their side of the loan, which had been, obviously compounding over time, but there theoretically is still equity within the home, which could go to your heirs or to others, but the bank may have gotten it out, which may be for a certain situation where kids didn't have to support parents at that time during that time frame. So that money's being potentially saved in other fashions, while it may be kind of given away at the time of sell. Is that kind of the process there, where yes, the bank is going to make money on this because it compounds. However, there's still the opportunity for the client to walk away with equity depending on home prices at the time. they can release those funds today instead of tomorrow when they absolutely need it.
Correct. And that's it, right? I mean, the national average for equity remaining in the home after a reverse mortgage maturity event occurs is 35%. That's the national average. So, more often than not, there's going to be equity left in the home. And yes, I mean, the money used from the line of credit, it's a warm handoff to their, heirs or, as opposed to a cold, cash is more important to their heirs than equity. It's more efficient, right? And so, I think that, the bank will get paid, but, what has been happening the whole way along where, I just had a Zoom call with 4 siblings and their spouses. Like, so there's 8 people on the Zoom and the borrower, and, they were just, no, we're doing a traditional loan. She's 70 years old and we're doing a traditional loan, we can work it out and we can do it. And we started talking about long-term care. We started talking about the cost involved. We have a software called Equity Tracks where we can actually show, what it looks like 10, 20 years down the line, that line of credit and what the balance of their loan looks like. And without question, all 8 of them, and to get 4 siblings and their spouses all on the same page by the end, they're like, no, we're doing a reverse, because they saw the advantage of it and the cost that they would not have to take on themselves. And the borrower didn't want that either. The parents don't want their kids to have to pay for them or take care of them, so it's a buffer asset. It's a buffer asset and helps everybody involved.
I know a number of times we've looked at it, a RELOC, the reverse mortgage line of credit option, has been less expensive on the rate side. And then, of course, you have the advantage of having this line. I think what is often confusing until you hear it a couple times, that it would be great if you can highlight a bit, is depending on the age the borrower is, will determine to the degree, right, or a component of it, how much, again, they have access to, right? And that's a protection mechanism. And then also, what I remember, even I struggled a little bit getting this at first too, was that the line grows, right? And so how that kind of works, it'd be great if you can explain both.
Thank you for those questions. The 3 things determine how much money a borrower gets on a reverse mortgage. To answer your first question, it's going to be the age of the borrower. The older they are, the more money they get. And they'll actually go to a birth date 6 months from the time of closing. So we'll take that next year or the next age. The second thing is what the house is worth. And then the third thing is what the expected rate is. It's a term you don't really hear with traditional loans, but basically the expected rate is what we, through a lot of calculations and analytics, determine the average rate will be for this borrower for the life of the loan. So those 3 things determine what the principal limit or what the loan amount is going to be. So, and with regard to the line of credit, so it's basically equal. So you have let's just say I'm going to make it in simple terms. You have $100,000 that you borrowed. Let's say you paid off a loan and your closing costs equal 100,000. And then you have another 100,000 that you have in your line of credit, right? So they're equal. So this 100,000 that you borrowed, let's say the rate is 2%. And by the way, the rates are about 2%. I'm going to get off subject here just for a second. The rates are lower than a traditional loan right now. They are lower than a traditional loan. So why wouldn't you pay the 2%, interest rate? If you feel like, well, I can make the mortgage payment, I don't need a reverse, I want to make my payment, well, then pay it. And every single dollar that you pay into that mortgage is going to a line of credit that's growing at that same rate. So, and you don't get charged on that line of credit only if you use it. But why not do that? You're paying down your mortgage, which is what you want. And now you have a line of credit that's also growing should you need it. When you're 10, 20 years down the line, you're 80 years old, you need to access that line of credit. Tax-free. income tax free. You still have to pay your taxes and insurance. So that is the basically the line of credit and how that works and how it's being, growing. It's exactly the same interest rate, and there's MIP on both. It's the same thing, except for they don't call it MIP on the growth rate. They just call it, it's just 0.5% higher. So, but it's the same. So, if it's 2.5%, then it's $250. Then $250 is growing on your line of credit as well. It's borrowing power. Don't think of it as accruing interest, because it's not. It's just increasing your borrowing power. But again, you don't pay anything on it unless you use it. So that's how that grows. I hope that helps. I hope that,
Well, with that, I think that it's time for us to wrap things up, Cece. So I'll start. So for me, honestly, I didn't know that much about reverse mortgages. So this has been very informative for me. Just hearing about all the different kinds available was very interesting. And it just led me to a better understanding that I am certainly not an expert in such things. And this is why there are experts like you available to people like us. So I think it's to our listeners and viewers, I think that it's important that if you ever do want to explore a reverse mortgage, that there are people out there who know a lot more about it than just the average Joe on the street. So when it comes to doing something this big, especially with what is in most cases your biggest asset, your home, you should always go speak to an expert. Don't just take the word from your friends and family on what is best for you, because they probably don't have all the pieces. And if a reverse mortgage is one of those possible options, you should go see an expert about it. With that, Tim?
Yeah. Cece, thank you so much for joining us. Really appreciate it. And my final thoughts come from, I had a negative connotation on reverse mortgages until we came up with a situation where we had to do some serious due diligence for a few different clients and really take a look at it. And it really just came from, the street, quote unquote, of where those misconceptions came from and how they actually work. And like anything else, it's really understanding it. There's some language in reverse mortgages that are complicated, but if you really just get yourself down in the weeds and start understanding the product and how it can be applied. I think I love that in your bio of how it's applied, right? In finance, I feel like our favorite word is it depends. Is a reverse mortgage right for you? It depends. What are your goals? What are your objectives? Does it fit what you're trying to achieve? And if it does, maybe it does make sense, and it can make sense in a lot of different positions, and sometimes it doesn't. So it's really just worth kind of taking a look at what you're doing. And what I mean by that as well is I loved how you talked about the mindset. I think it's very difficult sometimes when we grow up in an era or a way where our mindset is save, 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 always own your home. And then all of a sudden one day, Cece Delgado walks up and says, that's not the smartest move. And you're like, well, what do you mean? I've been told for almost 50, 60, 70 years that this was the smartest move. And it is difficult to make that adjustment, but that evolution does equate to success because it may has the product has changed, the environment has changed, your situation may have changed. So just because a reverse mortgage might not fit today, it could fit tomorrow or the next day. So it's that continuous look in the mirror and just seeing what you're trying to do. So I appreciate a few of those comments. I think that are extremely important, and obviously your knowledge set too was fantastic tonight. So thank you, Dan. I will leave it up to you for our last, and then Cece.
Just reiterating what these other two great dudes have said. It's just because something is right for one person doesn't mean that it is right or that they're even right to begin with. And so the idea of leaving no stone unturned is really a very important concept in all of finance, if not matters of life. It doesn't hurt to explore and better understand the situation and how it can help you. And we've seen it too. We recently had a client that Fairway helped where before the situation, she didn't have any cash flow. She had no free cash flow. She was breaking even at best. And that was dialed in, and we saw that, and there was no way to change that. Reverse mortgage stopped her payment. And now we see her living life a bit. And in all reality, that's been great for her. And it's been great for her kids to see this, who are also clients of ours. So it just doesn't hurt to do a little bit of digging and exploring, as long as you're associated with the right people doing that digging, right? Goes back to Tim's incentives question and so on. But there is a method to make sure that the exploration is done correctly. Cece, would you mind closing us out with final thoughts?
Yeah, I just briefly wanted just to respond to what Tim said about putting the mindset, of paying off a home. I really believe, especially with you young guys and working with millennials and all of that, I honestly think millennials would do, if they could, they would do a reverse mortgage all day long, because they get it, right? It's going to be a much easier sell in the future than it is right now. But I would like to close out with just, a little bit about Fairway. We're a 26-year-old company, number 4 retail lender in the country. And we are the only company that has boots on the ground in all 50 states doing reverse and forward loans. And I think that's a big deal. So I just want to kind of say that also, there's a big retirement crisis in the country. And thanks to you guys and Fairway, we can change the way retirement is done in the country. And I think that's important that we do that. There's $8-9 trillion in equity sitting there right now, right? And what would that mean if we had some of that pumped back into the economy? So I love what you guys are doing. We're all trying to make a difference and help. And so thank you guys for what you do as well.
Thank you, Cece. We really appreciate you sharing your insights today. It's a very valuable perspective on a topic that not a lot of people get the inside track on. And thank you to our great audience that always chooses to spend their time hearing what the three of us have to say, and the wonderful guests that we are privileged to bring on. So thank you for spending that time with us, as opposed to taking off your screen doors and trying to sell it for lunch money. Better time spent, we hope, here. Thank you, everybody. Have a wonderful evening.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.